Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts and market expert Dharmesh, Kant, Senthil, Manikandan of Newberry Capital and Avinash Gorakshakar of Joindre Capital join me on the show. Today on Hot Money, we'll discuss the power stocks. We'll discuss the Indiabulls group stocks, especially Indiabulls Housing Finance, whether it makes opportunity to buy some of these stocks there. Page Industries has been falling significantly. Today it's managed to rebound slightly on the Goldman Sachs upgrade, but whether we ask again why the street is not ready to take the explanation what the management is saying. And finally, battery makers like Amara and Exide have been falling now continuously post a weak set of numbers. Is it the right time to start accumulating these stocks? So that's something that we will talk about with our guest today. The first theme that we want to talk about is the power stock and the utility stock. So of late, yesterday, some of the power stocks did well in trade. Counters like an Adani Power managed to move in much higher. But does it make sense to buy some of these power stocks in a market which is not moving significantly? That's something that we'll ask our guests. So Avinash, I'll start with you. Power as a theme has been pretty stagnant, nothing much happening there. But does it make opportunity to invest in this? Is there any triggers that you see can come that could take the sector much higher?
I think Darshan, clearly from the generating company side, we have not been very positive. But especially from the distribution and the transmission tower side, I think there are companies which actually have delivered a pretty good set of numbers. So I think our sense is that the distribution and the transmission side of the business will make a large amount of money over the longer term. In the near term, there could be issues like the oncoming elections, and therefore some sort of delays could be expected in government projects. But overall, within the power generation side, the kind of issues we had on imported coal plus the kind of returns these companies have been making, I would believe that the transmission and the distribution space could be a better opportunity compared to the power generating companies. Okay,
so which stocks are you referring to here that if someone wants to take a exposure to the power space, which are the stocks that they should play?
We have been recommending to our clients, stocks like KEC International. The company has put out a decent set of numbers, a 10% growth in top line and a 15% growth in the EBITDA. What is interesting is, the visibility for the next 2 years is backed by very large orders, both on a confirmed as well as on a L1 basis. The company has an order book of more than 20,000 crores. And our sense is that now, apart from the normal domestic T&D business, they are looking at railways, they are looking at civil waterwork projects, and obviously the cable business. So clearly the company has made conscious efforts to diversify, and despite the fact that there could be a little bit stagnancy in the numbers going forward, our sense is over the next 12 to 18 months, this price discounts FY20 earnings by roughly about 9 to 10 times. So I would suggest that somebody who's taken a longer term view can definitely look at buying the stock on every decline. This can definitely give a decent risk reward provided one is a long term investor.
And the generators is something that you don't like at this point of time?
Generators, in fact, Darshan, you mentioned about Adani Power. I think it's a loss making company and it's largely a trader favorite. So I would believe that unless we get a decent track record of at least continued profitability, good ROEs and good return on capital, I think it's better to avoid, because fundamentally this does not suit the bill at all.
Okay, what about you, Dharmesh? Have you been recommending power stocks to any of your clients of late?
Not really. Who wants to buy power?
Okay.
So as I go by Avinash, like generators is absolute no. Because at 60-62% kind of a PLF, you don't have a merchant power, pricing with you. So it's 3.5 to 3.8 rupees per unit. At the same time, the power producers are looking more towards the PPA kind of an agreement. So they are insulated from any price fluctuation going forward. Transmission and distribution does have a takers as of now, but going forward as the transmission losses gets reduced, so even that sector will be a challenging sector because there will be too much of power, and with national grid integration and everything falling in place, my own sense is 10-15% more kind of power production will take care of 24/7 power supply throughout the country. So it has now become a utility. If you go 10 years back, it was a growth sector. So power was played not as a utility sector, but as a growth sector. With this becoming a utility sector in a country like India, where everything is so price sensitive, I don't think there would be any long-term growth story. I mean, compounding growth story won't be there. You can at best play, trading cyclical. So right now they are, very cheaply valued, and 10-15% kind of a bounce back, like in Adani Power or KEC International, as you pointed out, Torrent Power, can be there, and TPC for that matter, but nothing beyond that.
But what seems to have gone wrong for this sector? Is it that the regulations, is it that environmental clearance is not happening? You pointed out, it was a growth sector a few years ago, but somehow everything seems to be standstill here.
No, I have other viewpoint. Now things are getting right rather than going wrong. So when it was inefficiency, that time you were finding abnormal profits coming into the private place and all. Even merchant tariff was as high as 11 rupees at one point of time. So now when things are falling into place, everything is working fine, so efficiency has increased. So that has led to the destruction in the prices. So now this is what is the real picture, it will improve going forward. So then the valuation multiples and the earning trajectory and everything will change. So my own sense is like we have enough of capacity already in place. So no place for new players out there. So power generators and capital goods equipment maker who used to make BTG for the power plants, they will also take a backseat. Everybody has to renovate, and renewable energy is coming in a big way. So that is one area. Even the prices of renewable energy has corrected significantly. It's likely to correct going forward. So power is a utility play and it has done its course. I mean, the run has been.
So even if when you say renewal, so even counters like Suzlon or Inox Wind would be off your list.
Yeah, they are off my list just because of the balance sheet concerns which are there, especially in Suzlon.
Okay. Yeah. Senthil, are you recommending any of the power stocks to your clients?
So we're also quite selective in this space, considering the stress that the entire sector has gone through. So within the sector, we like CSC. So after the demerger of the Spencer's Retail and the CSC Ventures, now it's a pure play generation plus distribution. Here we are quite positive on their distribution franchisee, because if you look at currently they have distribution franchisees in Kolkata, and then they have a 49% stake in Noida distribution, plus they have subsidiaries which do distribution franchise in 3 areas in Rajasthan. So going forward, what you are saying is it's asset-light business and IROE businesses. Currently the management is also views demerging the distribution from the generation part. So once the demerger, there is no clear clarity because currently it's at the regulator side. So once the demerger happens, I think the distribution with IROE and asset-light business plus the growth prospects are quite abundant, because according to the government, they are going to bring around 250 areas where the private players will get the distribution franchises. So CSC has been I think the oldest power generation company in the Asia itself, and they have a lot of experience in the distribution side. So they could garner most of the areas. So we are quite positive on the distribution franchisee business. Plus currently the market cap is around 8,500 crores and they make a PAT of around 1,200 crores. And it's a free cash flow generation, and Q3 results, they announced a dividend of around 17.5 rupees. So comfortable with their balance sheet point of view also.
So you will buy CSC only once the demerger happens, not at this level. You would buy the distribution franchisee.
So it's an optionality. So we have a positive on the stock at present also, and the demerger will be a kind of optional value.
Okay, that's the view. So as far as power is concerned, very selective views that are coming in. Some of the stocks, at least generators, Senthil like CSC, and that too for the distribution business. Dharmesh does not like anything in the power space. Even Avinash is very selective, nothing on the distribution, nothing on the production side. Basically companies like KC International, which are into T&D, that is something that is being spoken about. The other group stocks that have corrected significantly and now are showing signs of minor bounce back are the Indiabulls group stocks, and one of the big movers there is Indiabulls Housing Finance. But is this temporary nature? Are you concerned with the business model of this franchisee? That's something that we will ask. Dharmesh, any of the Indiabulls group stocks would you accumulate?
Not really. The reason being Indiabulls is a very closed house kind of a business model they have. For that matter, Indiabulls Housing Finance, if you look at the business source, more than 2/3 is in-house.
Okay. So
it's not a pure NBFC play kind of a business environment where you have like a Bajaj Finance or a Capital First which was there. So, and even in housing finance, whatever they construct and produce, and the buyers of those residential houses are being financed by Indiabulls Housing Finance. So there is no diversification, there is no business at large to the public. So this is a big concern out there, and the type of CAGR they are posting around 30-35%.
Okay, Dharmesh, just hold on 1 second. I think we have the management of Tech Mahindra. Shares of Tech Mahindra hit a new all-time high after the company announced a share buyback. The BP operator plans to repurchase up to 2.1% of the total paid-up capital at 950 per share. To discuss this in more detail, we are joined by Manoj Bhatt, the CFO of the company. Also, we have Agam Vakil from our research team to take us through the entire conversation. Agam, over to you.
Thanks for that, Darshan. And Manoj, thank you for joining us and taking the time out. Some very few quick questions. Firstly, if you could tell us about the considerations that the board had made while coming up with a price of around 950 rupees per share, as well as just about 10% of the shareholders' equity, and why not more or less? Can you tell us a little more, give us a little more details?
Thank you, Agam. So I think from our perspective, first of all, I think it is this buyback is a means of rewarding shareholders who have stayed with us, and clearly we had said in the past that from an overall capital policy, we will return excess cash to shareholders. And so our maiden buyback, I think the reason we chose a route, which is the tender route and 10%, is that we wanted to start off in a manner that it is equitable and proportionate. And if you look at, obviously, there are enough precedent examples of what buybacks are happening at what premiums and so on and so forth. And we wanted to make sure that it is rewarding for shareholders to participate in this buyback offer. I think those were some of the considerations. I think from a overall capital policy, I think we look at buybacks plus dividends as a combination of returning money to shareholders, and that's something which we will continue into the future.
So based on your answer then, because this is your first buyback, can we also expect more buybacks to come through in the following years to come as well?
So I think in terms of obviously buybacks, I think it is a fair and efficient way to return money. And so from an overall return policy, I think we would intend to keep this as a continuous feature going forward.
Okay, Manoj, in the past couple of years, your dividend payout ratio has varied a little bit here and there. My question then is, does that substantially change your dividend payout ratio from here on as well, considering the buyback?
So the dividend payout policy is obviously a function. So I think stepping back, I think obviously we will reevaluate the need for capital at various points in time. So I think the second thing we had said is, since we had excess cash, I think we are returning that through the buyback. And in terms of the dividend plus buyback, I think you should see that ratio obviously has been increasing over a period of time. If I look at the last year, we returned about 46% of profits and 60% of free cash flows. And so clearly that's something we would like to keep in mind as we go forward also. And our cash flows and operating metrics around conversions have also been improving. So with all of that, I think we should obviously see a combination of dividends and buybacks. And we don't have a fixed percentage in mind, but as I said, the guiding principle is that we will not keep excess cash.
Okay, then Manoj, a final question then. If you leave aside the buybacks and the portion of cash for dividend payouts, where does that leave you when it comes to, well, your allocation towards capital expenditure, and secondly, any potential acquisitions that you may have in the horizon?
So when I mention all of these numbers, of course, I'm factoring in CapEx, because free cash flow, the way we calculate it at least, includes CapEx. So that's not a factor. So then the second question is capital allocation towards M&A. And as we speak, I think we are managing both. And if I look at the last 2-3 years also, we have managed M&A as well as increasing payouts on the back of improved performance in the business and improved conversion ratios. So to me, I think we will have to think of it as managing both, and that's something we will strive towards. And M&A will continue to be a core part of our strategy.
Okay, fair enough. We leave it at that. Manoj, thank you so much for taking the time out and speaking to us on Bloomberg Quint on the buyback. Thank you.
Thank you, Agam.
Well, on that note, Darshan, it's back to you.
Okay, so that was Tech Mahindra, but we are discussing Indiabulls Group here. So, Dharmesh, you were saying you were about to finish your point on Indiabulls.
It's just that centricity to the in-house business is my concern on the IndiaBulls Housing Finance. Had it been a pure NBFC place, even on the housing finance side, it would have been a different trajectory. So that is my concern, and I would rather buy a Canfin Homes or a Repco Home Finance rather than IndiaBulls Housing Finance if I have to buy a housing finance company.
What about the other group companies in that? Would IndiaBulls Real Estate or IndiaBulls Venture be something that you would look at?
Not really, because none of them have been doing really well. IndiaBulls Ventures have been posting good set of numbers though, but I would like to see 3-4 more quarters before to form.
Okay, Senthil, what's your view on the IndiaBulls Group stocks?
So particularly the housing entity, if you look at the Q3 numbers, their disbursement came at around 3,900 crores, which is like a lowest in the last 3 years. So clearly the management focus has now shifted towards liquidity enhancement. That's the reason I think going forward, so at least for the next 2 to 3 quarters, I think the focus should be on maintaining the liquidity and enough cash balances, and more focus and less focus on the growing the asset book. Second point is, if you look at the results, asset quality was stable, and even on the 3-stage asset quality is around GNP is around 80 bips. So on that side, I think they have done quite well, and they have a cash balance of 20,000 crores. So this is purely on the number side, but on the subjective side, I think considering the liquidity phenomenon across the sector, I think it will take at least for the next 2 to 3 quarters for the mid and small HFC players to get their cash balances to spur their asset book. Particularly on the valuation side, after the correction, I think it's trading around 1.5 times this year's price to book. For an ROE of around 26%, and they have a good dividend payout also. I think dividend payout is around 40%. So looking across the numbers, it looks good, but I will take a call maybe after 2 to 3 quarters, looking at how the book progresses from here. Okay,
Avinash, were you surprised with the steep fall that we've seen in the IndiaBulls stock? Is it now the right time to start accumulating them?
I think within the entire housing finance space, I think this group has always been very aggressive on numbers in terms of growth. And as Senthil said, now the focus of the management is purely on allocating good amount of capital where it is required, rather than looking at the growth in the AUM. I think disbursements have been down by almost 60% on a sequential basis, and I think the management did say in the conference call that they are looking at a 16 to 17% growth in the profit. But I think overall, the way the sentiment in the market is, especially the trust factor which is lacking from most of the PSU banks, mutual funds, I think it's going to be a very difficult time for getting fresh liquidity into the system. I would also concur with Senthil's and the views that this stock is definitely a stock where possibly one could see a little more deterioration in asset quality and growth numbers, at least for the next 2-3 quarters. So till that time, I think it's better to just stay away, because the entire housing finance pack as well as IndiaBulls Housing Finance could get a further beating down.
Okay, that's the view that's coming in on the IndiaBulls group stock. There is no traction that's happening. The next stock we want to discuss is Page Industries. Now, Page Industries today has managed to bounce back because of the Goldman upgrade, but ever since the numbers came out, it fell significantly, and the fall came in after the details indicated that there was excess revenues that were recognized because of the change in Ind AS. But the management of late has come out at least twice to clarify what this means and all, but the market somehow does not seem to believe it. So that's the big question that we are asking. So Senthil, why does Page continue to fall? The management has twice come out and clarified, there's no accounting scam or something. It's just that the accounting method has changed. But despite this, there seems to be a sell-off, apart from today where it's managed to rebound. But overall, why is this happening?
I think the sellers started with their Q2 results. I think Q2 results was way below the expectations. But if you look at the Q3 results, it was almost in line, and there was also a festive season backup. But if you look at the business prospect, I think it still remain positive for the next long term. Because I think their license pact with Jockey continues till 2040. So that is like fixed. And the second point is like the management guidance is like they used to grow at around 20% revenue growth, plus the margins also they expect to maintain around 20-21%. So they should be able to maintain the ROE of around 50% from whatever they're maintaining now. So we are quite positive on the business side, but if you look at the valuations, even after a 40% correction in the last 6 months, I think the stock is still trading at a high valuation of around 65 times price to earnings. So it's not still cheap. So businesses we are quite positive, but valuations doesn't allow us to go positive on the stock.
But you are satisfied with the explanation that the management gave?
Yes. So quarterly, maybe if quarter to quarter there may be some issues with the revenues and the business segment, but long term we are quite positive.
Okay, what about you, Dharmesh? What did you make of Page Industries? Is it a good time? Are you telling your clients to start accumulating?
Maybe 10-15% more kind of a correction can happen out there, purely on the valuation front. Nothing to do with the accounting method, because management clarified clearly that B2C sales is only which they are booking into the account, and which is the right method of accounting. So I don't have concern over there. If you look at the business, the model continues as usual. 20% plus kind of a growth is there. ROEs are in excess of 40%. And still the penetration level is very low. 5-6% is only, the people who are using undergarments. So this will expand. This will expand to places, remote tier 3, tier 4 kind of a cities. It will expand. And they have the brand equity in place. The type of material they supply is very good. The cash flow which is generated out of the revenues is humongous. So even they can replace the entire asset in 1 year's cash flow kind of a thing, and they double the business model. So no concerns out there. My only thing is, if you are getting 45-50% kind of an ROE with 20-25% kind of a growth, so maximum P multiple which you can get is 50-55. So there it is almost there now on a 1 year forward basis. And maybe at 16,000, 17,000, and since the market was bad, so everything was painted with the same brush. This stock also saw a correction. So it will be a time correction from here for a couple of years. But somebody wants to keep it for say 5 years, 6 years kind of a portfolio buy. It's a very good stock to buy. I see it as a doubler in next 5 years.
Okay, so it's an accumulation on dips. What about you, Avinash?
I think, Darshan, clearly, there's no doubt that the company's business model continues to be extremely robust. I would believe that, probably a 5 to 10% correction would be a good opportunity to actually accumulate the stock, because this accounting adjustment which has happened in Q3 is not something to be worried about, since it's not an accounting scam. It's just a reporting kind of number. One point which actually, the markets were also quite disappointed was that now segmental data would not be provided. So, that was also quite surprising. But overall, I would believe that a 5 to 10% correction can be used as a good opportunity to accumulate the stock. In fact, over the next say 2 to 3 years, this is definitely a story which is probably going to reward long-term investors.
Okay, that's the view that's coming in on Page Industries. And very quickly to the last question, battery makers are falling in trade. You've seen the bad results that came in from Exide. The counter is down almost at the 200 levels. Amara Raja today has managed to rebound significantly, slightly. But nevertheless, the traction certainly does not seem to be very encouraging. Avinash, any of the battery makers you like?
See, the businesses, they were dominated by only 2 players, that is Exide and Amara Raja, and within this pack we like Amara Raja. I think clearly both within the auto as well as the industrial segment, they have been increasing their market share quite steadily. And despite the fact that Q3 numbers were more or less flattish, our sense is that maybe for the next couple of quarters you could see the stock remaining range bound and margins coming under pressure, because it's a volume driven plus a price realization kind of model. But overall, I would believe that somebody who wants to take a 12 to 18 month kind of call, definitely Amara Raja would definitely be a well suited candidate. I think on the electric vehicle side also, they have been saying that they are going to put a lot of investment which would actually trigger the next kind of phase of growth. So I would believe that longer term, this model and this company would sustain, but maybe in the short term some underperformance could be expected.
Okay, what about you, Dharmesh? Any of these two that you're recommending to your clients?
See, both the companies have seen a stagnant kind of a profitability. In fact, it's a degrowth on a year-on-year basis kind of a scenario. Volume growth has been there, but they have been unable to capitalize on the pricing side. So there was no, they did not command the pricing power. So that was clearly visible in spite of lead prices getting corrected from $2,400 per ton to $2,000 per ton. Still, they were shrinking in the EBITDA and the profitability. So ROEs have come down. So a company which is not offering you a growth in the pink of the automobile boom which happened, and now it's going to plateau from here on. So replacement market segment, I don't see much of a value out there. As Avinash pointed out, this electric vehicles things, lithium-ion battery would be expensive capex. So my concern is right now you are already dwindling, the margins are dwindling, and then this capex will take its own course of time. Electric vehicles to be launched will be further delay. So your margins will squeeze further, ROEs will come down. So I see a bit of more correction. We like Exide for that matter, though both the companies are good. So I mean 20-25% kind of a price correction from here would be an ideal opportunity to buy as a trading
But
bet.
not at now.
Not now, yeah. It should
Okay,
be avoided.
Senthil, what's your view on the auto battery makers?
So among the business segment, if you look at OEM sales has been under pressure. But the replacement market is what we're expecting will drive the volume at least for the next 1 or 2 years. And I think within the replacement market, you have seen Amara is the better player compared to Exide, and it has done over last 10 years, it has gotten market share from Exide. But now Exide is also quite active in that space, and so both the players are trying to garner market share and also from the unorganized. So that's the reason, like Dharmesh mentioned, the raw material price has corrected last quarter, but the margins, EBITDA margins hasn't improved because a lot of promotional activities and spends they have been doing. So the margins are not going to improve from here, but and also one of the main driver is the OEM sales are going to be remain flat. So replacement market plus their industrial segment has to power the volume growth. Apart from this, the valuations have corrected and they are trading at around 7-year median PE. So it's I would say it's a reasonably valued at present. So it's not quite expensive, but we remain neutral on the stock.
Okay, so that's the view that's coming in on the final segment, and that was the battery makers. But with that, it's a wrap on today's edition of Hot Money. Thanks to all of my guests. Thank you so much, Avinash, Dharmesh, Senthil for coming in today. Our PQ comes up next, 8 into Bloomberg Quint.